Tesla stock has always been one of the most controversial investments on Wall Street. Some investors believe Tesla could become much more than an electric vehicle company, with robotaxis, artificial intelligence, robotics, and autonomous driving potentially creating enormous new revenue streams. But there is another side to the story. What if these businesses take much longer to develop than investors expect? And what if Tesla's automotive business continues facing pressure? That is the core question behind the Tesla 3-year bear case. The most important point is that Tesla does not have to collapse for the stock to disappoint investors. Tesla could continue growing, selling millions of vehicles, generating billions of dollars in revenue, and still deliver poor returns if the stock valuation is simply too high compared with the company's actual earnings and cash flow. When expectations are extremely high, even a successful company can produce disappointing stock performance. The automotive business remains the foundation of Tesla's operations. However, the EV market is becoming increasingly competitive. Traditional automakers and newer EV companies are investing heavily in electric vehicles, giving consumers more choices. If Tesla's vehicle growth slows or the company needs to reduce prices to maintain demand, both revenue growth and profitability could come under pressure. Tesla's historically strong automotive margins were one of its biggest advantages. But increasing competition and price reductions have made maintaining those margins more difficult. Tesla could potentially sell more vehicles while generating less profit per vehicle. For a company carrying a premium valuation, declining or stagnant margins can become a major problem for shareholders. Now we reach the biggest bullish argument for Tesla, robotaxis. If Tesla successfully develops large-scale autonomous driving, the company could potentially move beyond simply selling cars and create a recurring transportation business. Instead of earning money primarily when a vehicle is sold, Tesla could potentially generate revenue from autonomous vehicles operating continuously. The bear case asks a very important question: what happens if robotaxis take much longer to scale? Autonomous driving is not just a technology challenge. It also involves safety, reliability, regulation, consumer acceptance, and the ability to operate consistently across different environments. Investors therefore need to focus on actual deployment and financial results rather than relying only on future promises. Tesla's Optimus humanoid robot represents another enormous potential opportunity. If Tesla can eventually manufacture useful robots at massive scale, the market could be enormous. But potential does not automatically equal revenue. Tesla still needs to make the technology reliable, manufacture it efficiently, find customers, and generate attractive margins. This is where Tesla becomes particularly interesting. The stock price reflects not only what Tesla earns today, but also what investors believe the company could become years into the future. If robotaxis and robotics take longer to become meaningful businesses, investors could begin lowering the valuation multiple they are willing to pay for Tesla. Even continued business growth might not prevent the stock from underperforming. There is another factor investors should consider: opportunity cost. The market contains many companies that are already generating substantial profits and growing rapidly. If Tesla's earnings growth remains relatively weak while its valuation remains extremely high, investors could decide that their money has better opportunities elsewhere. That could put additional pressure on the stock. It's important to understand that the bear case is not necessarily a prediction that Tesla will fail. Tesla has enormous brand recognition, a global manufacturing footprint, a large customer base, and significant technological capabilities. The bearish argument is much more subtle. Tesla could remain a successful and important company while the stock delivers disappointing returns because the market has already priced in so much future success. Over the next 3 years, investors should closely monitor several numbers. Vehicle deliveries will show whether demand is accelerating or slowing. Automotive gross margins and operating margins will reveal how much profit Tesla is generating from that growth. Free cash flow will show the company's ability to turn operations into actual cash. Investors should also watch robotaxi deployment, autonomous driving progress, and whether Optimus moves from an exciting concept toward a commercially meaningful business. The bullish scenario is straightforward. Tesla successfully expands robotaxis. Autonomous driving becomes a major recurring revenue business. Optimus develops into a commercially successful product, and the automotive business stabilizes. In that scenario, Tesla could potentially grow into its enormous valuation. The bearish scenario looks very different. Automotive growth remains slow, margins stay under pressure, competition increases, and robotaxis and Optimus take longer than expected to generate significant revenue. Tesla could still be a major company, but investors might decide that the stock is simply too expensive relative to its financial performance. The biggest question isn't simply whether Tesla will succeed. The real question is whether Tesla can succeed enough to justify the expectations already embedded in its stock price. That's the difference between analyzing the company and analyzing the stock. A great company isn't automatically a great investment at every valuation. Tesla remains one of the most fascinating long-term stories in the market. The company could potentially transform itself from an electric vehicle manufacturer into a broader AI, autonomy, robotics, and mobility platform. But the next 3 years could be critical. Investors will need to determine whether Tesla's futuristic businesses are actually turning into scalable revenue and profits. Before making any investment decision, investors should look beyond headlines and ambitious forecasts. Watch vehicle demand, margins, free cash flow, robotaxi deployment, autonomous driving progress, and Optimus commercialization. If Tesla executes faster than expected, the upside could be enormous. But if the future takes longer to arrive, the stock could struggle even while the company continues moving forward. So, what do you think? Can Tesla successfully turn its robotaxi, AI, and robotics ambitions into massive profits over the next 3 years? Or has the market already priced in too much future growth? Let me know your Tesla price target in the comments. And if you enjoyed this analysis, make sure to like the video, subscribe to the channel, and turn on notifications for more stock market analysis.